Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today, and we've got some great topics to talk about. We're going to kick off the show with fast food restaurants like Wendy's are experiencing a slowdown in business. We'll discuss why that's happening, what's going on there. Not a surprise to me, because we've been talking about this on the show for probably the last couple of years, but we discovered that the affordability index for people buying a home is at the worst level in 50 years. We'll explain the details on that. And this one, I cannot believe when I saw the research on this, but the brokerage firm Robinhood looks more like a gambling platform than a brokerage firm. And when we start talking about it, Chase will say, no, that can't be true. You will not believe what they are doing. And I think their stock's up like 100% or something, but when you find out what they're doing and why, you'll kind of question, well, we'll talk about it more.
Their headquarters should be in Las Vegas is where they should be, honestly. I mean, they should have a casino and everything.
Well, remember we talked about it before where they actually go to Las Vegas and they, I think their top 1,000 clients, they got them go-kart racing, put them in casinos. So they're more like a casino than
maybe
they are.
it'd save them some travel expense if they're already there. So,
maybe, yeah.
But we're not going to talk about Robinhood fundamentals, not even frankly worthwhile since it is so expensive. But we're going to look at some other companies there. We're going to look at Cisco, Walt Disney, Spectrum Brands. May not recognize that name, but the big name that stood out to me was the George Foreman grills. Used to use one of these all the time in college.
Hey, what happened? You don't use it anymore?
No. Yeah, my wife is the main cook in the house now, so she's I let her do the.
You used to be a big barbecue, don't barbecue?
Oh, I still barbecue it, but I like the outdoor barbecue. I guess in Flagstaff, it's a little bit harder to barbecue when it's snowing.
Okay, there we go.
The last company we're going to look at, too, is a company called Maple Bear. Might not recognize that one as well, but it is Instacart. No clue why they call it that.
Oh, I thought maybe when we're talking.
We'll see if we can find an answer.
Okay.
Maybe ChatGPT has an answer.
I hope so. Well, let's talk about fast food restaurants like Wendy's are experiencing a slowdown in business. The fast food restaurant Wendy's is planning on closing hundreds of locations throughout next year because they continue to see a slowdown in spending from their customers. Now, they say most of their low-income consumers are cutting spending and making fewer trips with smaller purchases at the restaurant. So they're starting to feel that pinch on the lower-end consumer saying, yeah, I'm going to cut back a little bit.
Yeah, and this kind of, I guess, goes against that lower-end consumer when Wendy's increased prices, made it harder for them to afford potentially a Wendy's meal. But they did that again after the pandemic when there was a lot of costs that were coming into the system. And the interesting thing is that when they increased prices, it was at a higher rate than grocery stores. And now, again, speaking of competition, other fast food restaurants have begun to add value menus to keep customers coming back. But Wendy's has held firm and has not created any values for their customers, and because of this, they have seen their net income decline to $44.3 million from a year ago when it was $50.2 million. And the thing that I look at here with this competition, I know McDonald's has now really emphasized the value meals. There's just so much competition in this space. You know, again, we always promote the newsletter. I'm going to do a little plug here. We did another one talking about Mr. Colonel Sanders and KFC. Yeah. I mean, you look at all of these other players, they're going against, Chick-fil-A. They're going against this newer restaurant, Raising Cane's, Wingstop. I mean, there's been this introduction of what we call the fast casual space, not just fast food, where you're having your Cavas, your Shake Shacks, your Chipotles. There's so much competition out there for people trying to get a quick meal.
And competition is not good for a business because it means you got to compete, lower prices, and as you said, there's so much competition out there. You mentioned that they raised their prices. Wendy's did after the pandemic or during the pandemic. But if you remember, that's when people were getting all these free checks and everything else. Like, oh yeah, great, we got an extra $1,000. Let's go to get some fast food. Let's do this. So now those free checks are not coming in. And those lower-end consumers are saying, no, I have to cut back a little bit. So that's probably why it raised during the pandemic. They felt they could do it, but didn't think long-term.
Yeah, no, I mean, it definitely has been hurting them. And, one thing from our other posts, I got to bring this up because I thought it was so interesting, but 26% of consumers eat their fast food orders in their car. I was like, what?
And I look over at Priscilla and Sarah. Sarah shakes her head. Yes, she does that. And I just, Priscilla? Do you eat in your car? Yes.
Well, and honestly, I mean, I guess my favorite fast food is going to be In-N-Out. I do think I feel the best after it. I think it's, cleaner than the other fast food places. It tastes good. But when you go there and you go through the drive-thru, you're like, will you be eating in your car? And they give you like a little mat that you can
Really?
use. Yeah, I remember at the Scripps Ranch location, they asked that. And I was like, oh, I didn't know that was a thing.
Yeah, I just don't like eating in the car. It gets the car all dirty and smelly. I just like my car is super clean. I'm a car guy. So, but over the past year, the stock has declined from around $18 a share down around $8 a share, which is a decline of, 55% on Wendy's. With a reduction in the stock price, the dividend yield is now over 7%, and the company trades at 9 times earnings on a forward basis. I got to say, the company may, and I'm saying may, be worth looking into as an investment, as when the next 6 to 12 months, we could see lower-end consumers stabilize. So there could be something here where, and I've always liked fast food because it's a pretty good profitable item. Maybe it's not Wendy's. Maybe it's Jack in the Box. Maybe, I think those are only 2 pure plays I can think of. Well, McDonald's, obviously. Yeah. But yeah, I mean, there could be something there for investors. And have you had Wendy's?
I used to eat it in college. Harrison and I used to go get the junior bacon cheeseburger and a Frosty. It was a good deal.
I like their food. I just never think of going, and I don't do much fast food, but I just never think of, and aren't their hamburgers square?
Yeah, they don't cut corners, as they're saying.
They don't cut corners. So, but I don't know. There could be something there, for investors. I mean, it's something that I don't believe fast food is going away, even with the diet drugs. I still think people like fast food.
The thing, and I think McDonald's maybe has a more of an international presence, but I mean, when you look at the valuations on a McDonald's versus a Wendy's or even versus a Jack in the Box, it is very interesting why McDonald's, I mean, I think the premium they're getting over a Wendy's is like 3 times in terms of what you're paying for the earnings. Like I want to say McDonald's trades somewhere in the 20s on earnings, where again, now you're at, 9 times forward earnings on Wendy's?
9 times.
I mean, it is a huge discrepancy between the valuations on those two businesses, and I'm going to say a very similar space.
Yeah, maybe if you like Wendy's, go to Wendy's. Maybe look at buying the stock, But I don't know. Maybe it'll show up in our portfolio. Who knows? So let's talk about the affordability index, where people buying a home is the worst in 50 years. Now, people may be excited about buying a home because mortgage rates, well, they've hit some low levels compared to over a year ago. But the affordability of a home is still far out of the reach of many people. The reason for this is we have talked about this for the past, I think, Chase, we've been talking about this for at least 2, if not 3 years, is that the increase in the price of homes has far outpaced the increase in people's income. And we've talked about this, saying housing prices can't keep going up because people's incomes aren't going up and they can't afford it.
Yeah, I think we've been talking about this now for at least 4 years, because really it was during the pandemic, people were buying a house sight unseen. I mean, it really is when that price appreciation on homes got, I'm going to say, a little bit out of whack. And since then is really where that affordability index has continued to lift. And then what happened was, obviously, you had a huge cut in interest rates, which allowed prices to go up further. But then you haven't had the pullback in prices. Right. So now higher rates and higher prices, and again, not that appreciation in incomes, has led to this pretty crazy environment of having a hard time affording homes.
Right.
And I mean, speaking to the price to income, when you look over the last 50 years, the average is around 4 times, and it actually reached a low in 1999 of around 3.6 times. But again, with this rapid increase in the price of homes over the last few years, the price to income ratio has climbed to slightly over 5 times. Also not helping are the increases in home insurance costs and property taxes. Obviously, those are both going to be byproducts of the increase in home prices, because you got to repair a home if it breaks. Well, yeah, the insurance companies are going to have to pay more because home prices are elevated. Same thing with property taxes, since they're based off property values. So you're getting hit in all these different angles.
And you bring up a good point, because people don't realize that, well, gosh, my insurance went way up. That's not fair. Well, the price of housing is higher, cost of labor, materials, your property taxes are higher because of all these things. The price of the home is just not the price of the home. You got other factors related to that cost more as well. So, but kind of a comparison here. Back in 2019, the summer of 2019, when looking at households earning 75,000, again, this is nationwide, not here in San Diego, 75,000, nearly 50% of those people could afford to buy a home. Now, fast forward to today, when looking at those same households earning 75,000, well, now only 21% would be able to afford a home. Back in 2012, the affordability index was over 200, and it has now been cut in half to just about 100 with no signs. And I'm saying no signs of improving anytime soon.
Yeah, I mean, the only way to improve is you have to get a huge spike in wages, a huge cut in interest rates, or a huge fall in home prices, which I think people would welcome 2 of the 3, but just not likely that's going to happen.
Right. Well, I'll let you go ahead.
Yeah, I was going to say, because of this, it's not, again, going to change overnight, and I think it'll probably take 3 to 5 years to correct itself. If you look back at history, again, it's not like all of a sudden the affordability index is going to go from 100 to 150. It is going to take time to, I'm going to say, self-correct, because it is still based off supply and demand, and supply and demand will win in the long term. I think what is probably going to happen is incomes will increase slightly over the next 3 to 5 years, which should help with that index. And maybe the price of homes will either stay the same, or people aren't going to like this, but potentially decline slightly, which would increase the affordability index.
And I think, we read so much, we write so many different things. We did one about the new home builders. Did we post that one yet? It's going to be next week?
That'll be in 2 weeks.
2 weeks. Okay,
Yes,
2 weeks.
because we are off next week for the Thanksgiving
Yeah,
holiday.
we're taking that week off. So
Yes.
there'll be no newsletter, no
live show. We're going to
no
do our
live show.
evergreen show,
The
where
evergreen
it's
show.
still very valuable insight. Talk about our philosophy and so
Yeah,
forth. But
people want to like, how do they do that?
no
Well,
commentary on the news, I would say. So we're going to hold off on the new builder post until the first week of December.
But that does show a different story. It does show that, I'll just kind of tease a little bit, that prices are declining. And as you say, I think it will be a combination. People will earn a little bit more. Interest rates, I think, will come down maybe a little bit. And the price of home come down maybe a little bit. But it's not going to happen in 2 to 3 months. It's going to be time frame. And I always say, people, if you want a home to raise your kids and a place to live and you're going to be in there for a long time, it doesn't matter what the price of home is. But if you think you're going to buy that home and like, oh, yes, I'm going to make all this money, you're fooling yourself.
Yeah.
But what this means for people buying a home today is you should not have, as I'm saying, any aspirations of a rapid increase in the value of your home. What caused the problem was during the pandemic, and Chase, you kind of pointed this out, I'll mention again, worth mentioning again, pandemic mortgage rates dropped to lows not seen in 50 years, and that pushed up demand, and the prices for homes climbed at a rapid rate. I believe this scenario is extremely unlikely to play out again. I mean, it took a pandemic that we've not had. When was the last pandemic? 1918 or something?
The Spanish flu, right?
Yeah. So it just, you're not going to have that again. And please, I mean, if you're buying a home, great thing to do to raise your family and so forth. But don't think that you're going to flip this house and this is not 2020, 2021.
I mean, I kind of look at it, right, where people are going to not like what I'm going to say here, but it's an expense. It's not an investment in many cases. When I purchased my home earlier this year, it was because I needed a place for my daughters to have a backyard to run around in. And I'm not looking at it, as you said, to double my money on my home in the next 5 years. I definitely don't think that's going to happen. And when you look at it, if you go traveling somewhere, well, you're not getting an ROI on that. That's a pure expense. I mean, at least the home, you have a little bit better, preserving of that capital, but it is very possible that there is just not much appreciation. The big thing is that the incomes and the price of homes, they have to be somewhat correlated here. And incomes aren't going to go up 7% a year. That's not going to be healthy for the economy. So incomes might go up, maybe 3 to 4% a year, which is about what home price appreciation should be. But the problem is the valuations have gotten so extended that at best it might be 1% a year, because it needs to play catch up in terms of the affordability with how far ahead of it got itself. It's kind of like when we talk about the stock market. Earnings are going to be a function of how the stock market increases. We're at this huge elevated multiple now. Earnings growth is likely, I think, going to exceed what the return is on the S&P 500 because the multiple is so high.
Right.
I think it's a very similar case now in the housing market when you look at income growth versus price appreciation.
Yeah, and you have to understand things. Let's say we're not saying don't buy a home, but understand if you're buying a home, why you're buying it. And again, you brought up a great point. I want to have a place to raise my kids, have a backyard for them. And when you're renting a house sometimes, like a year down the road, the person on that house can say, yeah, I'm going to sell it. You need to find someplace else to live, So that's the benefit of owning your home. But again, you should have no expectations of, I'm going to make all this money on this house. I'm great, got to buy real estate. And please don't take from your 401k to buy a home. It just makes no sense. But let's move on because this is it just boggles the mind. The brokerage firm Robinhood looks more like a gambling platform than a brokerage firm. What are we talking about? Well, Robinhood initially went public at $38 a share in 2023, and then the stock fell to under $10 a share. Like, oh my gosh, it was terrible for this company. It wasn't going to do anything. Well, it has since recovered, and it's now trading somewhere around $107 to $110 a share, depending on the day. What has caused this shift and the huge increase in the stock price? Well, one big reason is that the company has really allowed major, not just little speculation, but major speculation for their investors. And this is going to cause so many people to lose so much money. Let's talk about it. Let's talk about
I mean, the big thing that I think they've kind of tried to take away from like the big brokerages like Schwab and Fidelity is the crypto space. They're like, oh, you can do crypto here too. That takes on to that whole risk theme that they like to live by. And I mean, they've allowed people to buy coins like Bonk, B-O-N-K, never even heard of it, Dog with Hat, and Pudgy Penguins. And I looked at these today and I was like, what in the world? Pudgy Penguins has a market cap that was over billions of dollars.
Are you kidding me?
Yeah. Dog with Hat is about, I think it was like 500 million, but at one point it was again billions of dollars in market cap. And it's like, what in the world? Like, these things are just crazy. And just when you think there's no way they could come up with anything more speculative, surprise, and this is what I'm talking about, maybe they need to be headquartered in Las Vegas, they have come up with an investment known as prediction markets and event trading. And somehow the regulators have let this slide, or maybe since government agencies don't move that quickly, it just has not been addressed yet.
And I'm wondering if this, because we have seen Bitcoin fall from 125,000. I saw it on Friday around 82,000. I think it
fell as low as about 80.
80.
It almost tipped into the 70s,
right,
but not quite.
And that could cause, I don't know, what is dog? What if?
Dog with hat. Like,
with
I
hat.
think it's supposed to be with hat. And I
With
looked
hat.
online and it had like this dog with different hats. I
can't even say the name. Yeah, Pudgy Penguins, Bonk. I mean,
I thought honestly when you wrote dog with hat it was a typo, but no, that's the real thing.
yeah, it's the real thing. And it's just, these have to be cratering. And this has to going to be a problem.
They're nothing. I mean, they are absolutely nothing. And I don't want to say that people deserve to lose money, but if you're doing these things, frankly, you deserve to lose money. I mean, there's no fundamental reason to buy Pudgy Penguins.
Well,
what are the fundamentals on Pudgy Penguins crypto?
I would be embarrassed to tell people, what are you investing in? Oh, Pudgy Penguins. Like, what? I mean, and it appears that on their app can predict what the outcome will be of a football game, politics, contracts over economics, even, and I read this, I read it a couple times, even if aliens will exist on Earth this year. And I think the investment was like $4, and you have a chance to get $100. I mean, right? I know you look at me like this can't be true, but Chief Brokerage Officer Steve Quirk says that this is the fastest growing business we have ever had. No surprise, you're gambling. Robinhood stock trades over 50 times projected earnings and is looking for about $4.5 billion in revenue, which is an increase of 53% over the last year. I mean, we talk about this stuff. I mean, when you go to a casino, they do have a thing called Gambling Anonymous. Well, I think when you open the brokerage account with Robinhood, there should be somewhere there, here's the number for Gambling Anonymous, because this is, I don't care, they made a different name, predictable markets, you're still gambling. There's no fundamentals, there's no earnings, there's no dividends, you're just gambling on something.
I just don't understand. Some states, they don't allow for online sport books. Like you
Right.
can't bet against sports, but you can do a prediction market. It's the same. I mean, I don't care what anybody says. It's the same thing. And how are the gains taxed? Are the gains taxed as short-term gains? I mean, what?
Yeah.
I mean, it's just kind of crazy that this is frankly allowable.
Well, as you said, maybe the regulators just haven't got caught up yet, because maybe what they're waiting for, they're on the back, yeah, we need to do something on this, waiting for it to get bigger and bigger, and then they have more to go after maybe. But it's like your tax return. I think they have 3 years to audit you. You never get audited after 6 months. Yeah. It's usually after 2.5 years. That's when you get the notice. So we could see in a couple of years, all of a sudden, Robinhood, like, what? Oh, what? They're getting, fined, penalized, or what?
I mean, they just are doing so many crazy things. Obviously, they're trying to do, the stock tokens rather than equities. Now they can't do that here in the U.S., thankfully. I mean, it just is so far removed from actual investing, and they're making so much money off of other areas rather than actual investing that it just boggles my mind. And, we talk about this growth. I mean, and you mentioned the number here that revenue is going to increase 53%. So maybe you can justify a higher multiple on it. But as we've said, there's just so much speculation and these insane, crazy things that there's no doubt in my mind that in the future, many people, I don't even think a few people here, many people will lose more money than they ever thought was possible by speculating on these crazy things rather than investing into good quality businesses, which I'm sure Robinhood doesn't make any money off of. A fallout, though, in those risky investments, and I call them quote-unquote investments, could hurt Robinhood's reputation, which I believe would be bad for the long-term growth.
Oh, yeah.
And right now it's hot. People are making money off of dog whiff hat. But again, you lose your whole investment. We know that we live in a blame culture.
Right.
People aren't going to blame themselves. They're going to blame Robinhood.
Oh, yeah.
And I think 5-10 years from now, if we have a huge collapse in a lot of these markets, who's going to get blamed? Robinhood.
Yeah.
And I think they will have a very hard time growing, if not even sustaining business.
And you say 5 to 10 years. I think it could be even shorter, 2 to 3 years, because I just can't see this going on. And I've seen things like this in my past, doing this for over 40 years. I've seen things like this happen. And it's like, it's great now. It's funny. We laugh at it. People are like, oh yeah, I bought what dog with hat,
Whiff hat,
with hat,
WIF, dog whiff,
hat, whiff. Okay. Not with, but dog whiff hat, and they, oh yeah. And I made money on it. And so these things are going to crash. There's no doubt. And you know what people are going to say, Chase? Oh, investing in stocks is risky. You were so far away from investing. You were gambling. Don't ever say that investing in stocks are risky, because if you look at earnings and cash flow, all these other things, you're going to do well. But it's just a shame that these things happen. People will lose money on it, same way they go to Vegas, and it's just we want to bring that up to you. I think if you have an account at Robinhood, take your money somewhere else. So
I mean, you can do normal investing at Robinhood, but I think the temptation to do these crazy things is just too large.
Yeah, I don't think I would want to deal with Robinhood. Should we deal with the company?
Let's do it.
All right, let's talk about Cisco. Now, I kind of messed up that lead in there because I want to talk about November 14th. What happened on November 14th? Well, November 14th was a very special day. What was that day? Well, that was the day that after 25 years, Cisco, after the internet boom, hit an all-time, or actually matched their all-time high back from 25 years ago. So we thought, hey, let's take a look at the fundamentals of this to see, is it going to do the same thing as a peaked out or not? The company we're talking about is Cisco. Used to be, it is still Cisco Systems, symbol is CSCO in the communications equipment industry, only 1.2% short on the float side, 81% institutional owned. We do see a PE ratio, not bad, 29.4 versus 36. It was, I think, around 130 back 25 years ago. So they've better there at 29.4. But price to sales not looking good, 5.3 versus 2.8. Price to book value, 6.4 versus 4.2. Price to cash flow, 22.1 versus 19.9. And the PEG ratio does look good, though, 2.4 versus 6.8. Shows you're paying lower for the growth of the earnings. Now, they have grown their earnings over the last year by 11.2%. That's above the industry at 9.7%. Sales are up 8.9%, slightly ahead of the industry at 8.5%. And the 5-year earnings per share growth estimate from the analysts is 7.6% versus 6% for the industry. They do pay a 2.2% dividend, use 63% of their earnings to pay that out. Let's take a peek at the balance sheet. Current ratio 0.9 versus 1.5. And I'm kind of surprised. I thought that would be better, but it's not bad. It's just not as good as I thought it was going to be. Debt to equity 0.6 versus 1.1. I do see here something I don't usually talk about. The intangible assets are 56% versus 40% for the industry. So a lot of intangible assets that could be, I say could be written off, which could hurt the stock somewhat. They do have a nice profit margin of net profit margin of 17.9 versus 8.3. Return on equity 22 versus 20.9 for the industry. Return on invested capital 15.8%. Free cash flow very good, 12.7 billion. That's double the industry at about 6.5 billion. Chase, what do you got?
Yeah, those intangibles, a large part of them potentially could come from, they did an acquisition back in 2024 of a company called Splunk for about $28 billion, I guess. So it was a big acquisition.
Was it an AI company? Do you know what it was?
I don't know exactly what Splunk did. I had a friend of a friend that worked there, and obviously they were all into it and said, oh, it was a great company, but I don't know what they did.
Yeah. If you're going to invest in this company, you want to know what that is, because if that's AI chips or whatever, that could be written down because they paid a lot for that company.
Yeah, $28 billion is a hefty investment, especially considering the market cap's about $300 billion. I mean,
yeah,
it's about 10% of your market cap. That's substantial.
A few $1 billion write-off.
Yeah. But looking at the current price here for Cisco, again, their ticker symbol is CSCO, $76.10, 52-week range. The low here, $52.11, and the high, $80.06. Year-to-date, stock's done well, up about 28.6%. Going forward for Cisco, though, is a little bit disappointing. Not as bad a valuation that we had during the tech boom, but we go out to July 2027, estimated earnings per share of $4.47, gives us a target sell of just $74.20. That means it trades around 17 times those future earnings. So not a value any longer. And this is one of the last, I'm going to say, big tech companies that seem to have fair valuations and now, well, I should say, had undervalue potential. Now it has what I'm going to call a fair valuation.
Well, you said 78. That's about where the price is. You said target sell price was 70.
Target sell price is 74.
74. Okay, so it's
right about in line with historic multiples.
And you've done very well with the stock over the last few years. They've done some great things. They said the magic words AI, and their stock goes up. And I mean, the numbers do look pretty good. The analysts, 24 of them, low 432, high 464. But I just would not see any reason to continue to hold this stock. And back in the tech boom, when it was at 78, I said, yeah, you should be selling this. People say, oh, you don't get it. You don't get it. Well, I'm sorry. The fundamentals, again, say time to sell again.
Well, again, we wrote a post on Cisco and going to give a little bit away here, but Barron's actually came out with an article that year talking about how it was trading at 130 times estimated earnings and how it's like, gosh, this doesn't make sense. And people thought they were crazy. Well, by October 2002, the stock traded under 10.
Yeah.
So again, that is where valuation, it doesn't necessarily mean anything in the short term, but long term can have a huge impact. And that's why we don't like to overpay for anything.
Yeah. All right. Well, we're going to take a quick break here. When we come back, we'll be talking about Disney, Spectrum Brands, Maple Bear. Stay with us. Also, to Harrison, our financial planners coming up. Stay with us. You're listening to Smart Investing Show with Brent and Chase Wilsey. All righty. Welcome back to Smart Investing Show. And, it says right here in big yellow letters, promote newsletter. And I always forget to do it. And it's so valuable because this is something that when you get the newsletter, you'll be so informed about what's going on. Some of the topics we didn't talk about today was what to do before the spouse who manages the investments passes away. Do you know who the beneficiary is of your retirement accounts? Check your coins. They could be worth a lot more than you think. The chicken wars have become, Chase talked about this a little bit, intense because Colonel Sanders, well, he's losing the chicken wars. And how big government, well, we think is maybe gone soft on big corporations. So it is a free newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Right in the middle of the page, you'll see newsletter. Sign up for it. It is free. I think you'll enjoy it. And Chase, I get so excited about jumping into the companies. I always forget to promote the newsletter. So you got to kind of.
Hey, I promoted the newsletter.
Chase.
I promoted it twice today. So
yeah, but you didn't say where to go to get it.
yeah,
That's how good it is, and it's very good. But yeah, we got a lot of people love it. But let's talk about financial planning. Sitting here with us is Harrison Johnson. He is a certified financial planner. Today, talking about financial planning, the real cost of employer coverage versus Medicare. What are you talking about here?
So I had a conversation earlier this week, and it kind of inspired this. when you get to 65, that's when you're eligible for Medicare. But sometimes you have the ability to stay on your own plan through your employer, or if your spouse is still working and they have health insurance, you can potentially go on to their plan. So, at 65, you have this decision. Do you go ahead and enter the Medicare space, or do you stay with an employer plan until your spouse retires or until you retire? And the difference here, there's a lot of differences, but the difference I want to point out is from a tax perspective, these are two very different things. When you go onto Medicare, no matter who you are, you have a Part B premium that you have to pay, and then that can be higher based on your income because of IRMA. And then if you have an Advantage plan or a Medigap plan, there's these different premiums that you have, or you might have a Part D premium. So there's Medicare premiums, and they're considered medical expenses, which potentially are deductible, but it's an itemized medical expense deduction. So you have to itemize, which a lot of people don't because of the SALT cap being removed. More people are going to be able to itemize. But the other thing is medical expenses as an itemized deduction, you can only write off or deduct the medical expenses that exceed 7.5% of your adjusted gross income, which is a very large threshold to get over. So if you have an AGI of $100,000, the first $7,500 of medical expenses are essentially not deductible. And only the excess then is an actual itemized deduction. And then, all of your itemized deductions have to be greater than the standard deduction to be able to get any benefit at all. So the takeaway there is for most people, Medicare premiums are not deductible, or they don't, actually help your tax situation at all. When you have health insurance premiums that you pay through an employer, it's generally part of what's called a Section 125 cafeteria plan, which means those premiums are pre-tax. In California, if you're an employee, most employees have 5 different income taxes that they are paying. There's federal, state, Social Security, Medicare, and disability taxes. And health insurance premiums are pre-tax on all 5 of those taxes. That's different than a 401k, for example, that is only pre-federal and state tax. You're still subject to payroll taxes, but health insurance, it's pre all 5 of those taxes. So if you're in the 22% tax bracket, you essentially receive an over 40% discount on any health insurance premiums that you're paying through your employer. So when you're looking at, going onto Medicare versus comparing those health insurance options, obviously the coverage is a little bit different, but when you're making that decision, you need to weigh what the after-tax cost of those 2 different options are to really see, what the best option for you is going to be.
And, this does surprise me. I thought whenever you hit 65, you had to go on Medicare, but you're saying that's not the case. There's ways around that.
There's ways around it. And I mean, sometimes Medicare is the right thing to do, right? Yeah. So when you turn 65, if you're still working, generally you'll get Part A. Part A doesn't have a premium to it, so you jump on that when you're 65. But if you're covered by a qualified plan, which a plan through your employer, whether it's yours or your spouse's, if you're on that plan, you don't have to go onto Medicare. So let's say you're 65, you start Part A, you're still working though, and then you retire at 67. At that point, you would go onto Medicare, or you'd go onto a spousal plan. So you have a choice of, do you want to go onto the full Medicare and add Part B and the supplement plans and the Advantage plans, or can you get the coverage that you need potentially at a lower cost while staying with your employer or going onto a spouse's plan?
And I don't think anybody's ever talked about this before. I mean, I'm sure somebody probably has, but it's just like, I doubt very seriously 99% of financial planners would bring this up, because it's way out in left field, but it could be a big thing because you don't put the taxes. There's so many benefits to it. I mean, these are things you think about that people, like, I never thought of that.
And this kind of came up in a weird way. I was meeting with some people this week, and we were talking about other things, and husband and wife, wife was retiring, and the husband was like, oh yeah, she's just going to go onto Medicare because if she goes on my plan, it's really expensive. And I'm like, well, what's really expensive? And it turns out after tax, it's actually cheaper to go on that. So it wasn't a question. It was just kind of something that they had brought up. And then, we looked at it, and that's actually going to be a more comprehensive and cheaper overall plan for them to go on.
And sometimes employers will subsidize some of the cost. If you don't use that benefit of their health insurance they're offering, they don't give you money back, right, if you go on Medicare?
Sometimes they do, but generally in the case of like a spouse, definitely not. So like in this case, The husband, who was still going to continue working, his insurance was completely paid for by his company. If he added a dependent, like his spouse, then it was going to be a little bit more money. But looking at their tax bracket, the net cost of that, especially because they would have triggered IRMA and there would have been a higher Part B premium. And in 2026, Medicare Part B premiums are going up anyway. Having her on his plan turned out to be quite a bit cheaper.
So many things in financial planning that people just don't think about, and they miss out on some big benefits, some big tax advantages just by talking with you, because you look at many different factors like, wait a minute, maybe we should look at this.
Yeah. And I mean, some things are really big. In this particular case, it translates to, I don't know, a couple $100 a month or maybe a few $1,000s a year. So it's not breaking the bank, but you might make the wrong decision and then just never know about it.
Yeah.
So if you can just make the right decision here, the right decision there, the right decision here, it adds up, and it just makes life a whole lot easier if you don't have to worry as much about, finances, and you're all taken care of.
A little bit adds up to a lot of bit, especially over years.
Absolutely.
Yeah. Well, Harrison, great information. Thanks very much. We'll talk with you soon.
Thanks, guys.
All right. Again, as Harrison Johnson, he is our financial planner, our CFP at Wilsey Asset Management. If you'd like a free consultation to find out maybe you have things that you're not taking advantage of, he can talk to you about that. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can send him an email, say, hey, I'd like to sit down with you, have a free consultation, and he'll do that with you. So that was a great topic.
That was a good one. Yeah,
Yeah,
something that I think, as you said, a lot of people don't think about.
No. Well, let's move on to a company that probably nobody's ever heard of, this company called Disney. They've had some stumbles lately, and we want to kind of look at the fundamentals of Disney. Their symbol is DIS. They're in the entertainment industry. A lot of activity in the entertainment industry with Warner Brothers and Paramount and Netflix, and I forget everybody. There's so many things going on right now. But Disney has faltered on their stock. So let's take a look at it. And actually, 75% institutional owned, only 1% short on it. PE ratio, not a bad start, 15.2, nothing for the industry, not material. Price of sales is 2 versus 2.1. Price of book value looks good, 1.7, half the industry at 3.4. Price of cash flow, 10.4 for Disney, nothing for the industry. And no PEG ratio for Disney, so that's kind of disappointing. I would like to see a PEG ratio there. Now, over the last year, their earnings are up 151.8%, industry up 102%. That's got to be something to do with accounting or some bad numbers the previous year, because I know Disney's earnings have not grown 150% year over year on a straight line basis, we'll call it. Sales were up 3.4% versus 2.2%. The analysts are not looking forward for good earnings growth on Disney. They're saying a negative 46.6% over the next 5 years. That's their estimate. Industry at 24.3%. I don't know what they're seeing that they think things are going to be so bad for Disney, but that's what they're saying. Dividend yield 1.4%. Gosh, Disney, you could raise this because you're only using 14.5% of your earnings to pay that 1.4% dividend. Let's at least get that up to 2%, I would think. The balance sheet, current ratio, maybe that's why the dividend's not high. It's only 0.7 versus 1.2, so they could be having a liquidity problem. The nice thing, the debt to equity is only 0.4 versus 1.3, but they are absolutely not sitting on a lot of cash and liquid assets that they could use to pay debt if they had to. We do see the net profit margin, 13.1. That's good compared to the industry at 6.9. Return on equity, 11.3. It's not great. Industry's at 20.4. Free cash flow is very good, though. That's $10.1 billion above the industry at $6.4 billion. So I do like seeing that. Jace, what do you got going forward?
Yeah, a couple of things. Number one is on that current ratio. You have to remember Disney is I'm going to call it a travel company as well. Mm-hmm. They do a lot of cruises. They actually just invested, I know, in another cruise. And we held a cruise line in the past. And what happens is when they sell a ticket, that becomes a current liability. So that can distort that current ratio just a little bit.
I mean, and if you're going to look at investing in this company, I think you want to find out how much the cruises account for the revenue of Disney, because they got movies, they've got They still have sports, right?
Yeah, I kind of looked it up here. So entertainment, that's going to include your direct-to-consumer, so your Disney Plus, your Hulu, your linear network, so ABC, your Disney channels, and then some advertising and affiliate fees. That's about $41 billion in 2024 was their revenue there. Then they have a sports division, which is going to be mostly ESPN. They broke those two out. Now ESPN's about $17 billion in revenue in 2024, and then your experiences, that's going to be your parks, your cruises, your resorts. That's about $34 billion. And actually, the experiences last year was the most profitable segment of the three.
Really?
Mm-hmm. So
it's expensive going to Disney now.
Oh,
I'm glad
crazy.
you guys are older, but I don't think you can, with a family of 4. I believe if you take a trip to Disney for the day, I think you're gonna spend like $1,000.
Oh, probably at least.
Yeah.
I mean, it's gotten crazy, but people are still doing it, and it's a bucket list item for a lot of people. And people that are avid Disney people, they'll still spend it because it's where they want to spend their
Couple
money.
of years, your girl's gonna want to go.
Yeah, still got some time, thankfully. So we'll see. Other thing I was going to say, too, about the dividend, they actually just increased the dividend by about 50%. So there was a dividend increase, but that level you gave is the current level. And the other interesting thing about their dividend, it's not quarterly, it's semi-annual.
Oh, that's not nice.
Yeah, I mean, it's interesting, but yeah, if you're a long-term investor, it shouldn't necessarily matter. But just something to point out, if you're buying an X dividend, you won't get it in 3 months. It's something that you have to wait every 6 months for.
I think it's Mattel is once a year in October.
There's some that have special dividends, and it looks like pre-COVID Disney's semi-annual dividend was about 88 cents, and now it is going to be 75 cents. So, I mean, they are still short what they were pre-COVID.
Yep. But
numbers for Disney. We look at the current price here, it's $104.28. 52-week range low here, $80.10, and the high, $124.69. This is where things get a little bit interesting for Disney. We go out to September 2027. I see estimated earnings per share of $7.35. That gives us a target sell price of $122.01. So it is above the current level. It is in our hold category, though. Right. It's not at our 30% margin of safety. We would need Disney to fall about 10% down to around $93 a share to hit that 30% margin of safety trigger. But where I look here as it being interesting is the earnings growth estimates are pretty strong. I mean, they're looking for earnings growth this year of about 11%, next year 11%, the following year 10%. I know Bob Iger on the conference call talked about multiple years of double-digit earnings growth. I mean, you're getting a reasonable multiple here and double-digit earnings growth with a good brand name. I mean, if this thing did pull back to that 10% level, I'd have a lot of interest in it, I believe.
Yeah, and I'm sitting here, we talked about Wendy's with a lower-end consumer. I'm just not sure how the lower-end consumer is going to be affected or Disney be affected by that. I don't know if they – and, you see lower-end consumer. You never know what that level is as far as income goes. But are they going to Disney? They would go to Disney. That they won't go to the theme parks. These are things you got to kind of consider when you're looking at Disney. I did notice that there's kind of a big range in that 735. There's 25 analysts. The low is 649. The high is $7.87. So it doesn't make me feel really comfortable that that's a good number. It could be a little bit higher. It could be a little bit lower. So I think it's worth watching. As you said, how far away? Because it's in a whole category. I mean,
I said it's about probably around 18-20% away from its target sell price.
Okay, so we'd have to get it.
It's a 10% decline is what we need for the 30% margin of safety.
So, yeah, and I don't know if it's being held up, and they're not in the bidding war with Warner Brothers. I did not see them mentioned.
But I mean, here's where it's great. Netflix's market cap now is over $400 billion.
What is Disney's?
$130 billion.
Wow.
So I just think I'm sorry, $183 billion. I had 3 in the wrong spot. I think to get a brand name like Disney at that type of multiple is worth that risk potentially of the analyst estimates having that larger variance than we'd normally like to see.
And you point out it is diversified with the cruise lines, the parks. You got the TV. You've got
ESPN.
Mickey Mouse, ESPN. So it's a very good diversified business. It just doesn't seem to be clicking on all cylinders at this point in time.
Which is when you want to buy.
That's right. But not yet.
Not yet. Not quite.
You want to put it on the watch list.
If we can get a market pullback, I think you could see Disney become a very viable opportunity.
And they are on calendar year, correct?
No, they're fiscal basis.
When's their fiscal year over?
So they just actually moved forward. So September.
Oh, September. So they just okay. So because I was thinking, well, after the first year, you'll see new numbers, but we won't until
We
September.
just got the new numbers, which is why the valuation looks attractive.
Better, but still not good to buy. So
Well, it's okay. The whole category is, again, okay.
yeah. You can tell from our kind of hesitation here. We're not like excited about it, but it's worth watching. I think
I'm excited with the 10% pullback.
Yes, there we go. And you're excited to look at it because again, it's definitely a brand name that is worth considering. But let's move on. And this one here, whenever I see it, I think of Spectrum, the cable company, not Spectrum Brands Holdings. Which
I had never heard of this company.
No, I never did. I've heard of their products, which I know you're going to talk about the products a little bit, but I just never. Spectrum, you automatically think of the cable company. But Spectrum Brand Holdings is the company. Their symbol is SPB. They're in the household and personal products industry. Ooh, short on this is 16.7%. So they're looking for a pullback in the stock. The shorts are. We do see a decent PE ratio of 14.9 versus 25.2 for the industry. Price of sales looks good at 0.5 versus 2.5. We do see price to book value 0.7 versus 4.9, so that's pretty attractive. The price of tangible book value is higher at 12.7, but the industry has a price to tangible book value of 83.3. And you, again, want the company's valuations lower than the industry. We do see price of cash flow 7.3 versus 16.9, so that's a positive. PEG ratio 1, that's very good. Take a look at the earnings over last year. They are up 18.1%. The industry is only up 7.7%. However, sales for Spectrum Brands Holdings did fall by 5.2% when the industry was up 1.1%. The analysts, or the 5-year earnings growth estimate, they're saying 13.2% is what they're looking at for the growth in the earnings versus decline of 12%. So I'm not sure why there's such a big short on this company. You get a nice dividend, 3.3%. They only use 48% of their earnings to pay that out, so that's a big positive there. The industry has a yield of 2.8, so they're above the industry. Still questioning what the short is here, why there's a short on it. Maybe it's the balance sheet. The balance sheet, current ratio 2.3 versus 1. Well, a lot of liquidity there. Debt to equity 0.3 versus 1.2. Not much debt on the balance sheet. Let's see, net profit margin 3.6 versus 10.4. So maybe the profit margins on the products are lower, perhaps causing some problems, and return on equity is low at 5.2 versus 27.4. So it could be a profitability issue with the company. Free cash flow is only $165 million versus $7.7 billion for the industry. So maybe you have something exciting going forward, Chase.
Yeah, current price here for Spectrum Brands is $57.38. And again, their ticker symbol is SPB. 52-week range, though. $49.99 is the low and the high. Wow, $96.62. Year to date, the stock is down 32%. Over the last 5 years, I mean, the stock has really not done much and actually has declined about 14%. Over the last 10 years, down 33%. So, I mean, this has not been a good performer. And I'm almost wondering why. I mean, it doesn't seem like there's that many problems, especially to warrant a 16% short on the float there. That's pretty crazy.
Maybe it just got too high too quick, and the shorts haven't left yet, because you said the high is what, 96.62. It's now 57.
Yeah, about 99.
Yeah, that's a big fall.
Yeah, 96.62 is the high there. But going forward, I mean, again, the valuation looks good. I mean, you go out to September 2027, estimated earnings per share here is $5, gives you a target sell price at $83. You are looking for earnings declines in 2026 of about 18%, but it looks like that'd be the trough, and now you're looking for earnings growth again next year of close to 13%. I mean, look at the brands. I mean, there's a lot, frankly, that I don't recognize. The big one that I mentioned is George Foreman. The other one is Remington, and I was like, what is Remington? It's Remington razors, but I was like, I knew I recognized this.
But they're electric razors, aren't they?
Yeah, and they do my nose hair trimmer. And then also... it is what it is.
You just
and then
talk about what they have.
And then I think they also had, I used to use it when I was in high school, and I used to buzz my head.
Oh, that's right.
Yeah. So,
right.
And then they also have, home and garden products. I'm not as familiar with some of these. And then Global Pet Care, I did see they have this thing called Dream Bones, which I do get for my dogs.
But what are dream bones? Are they?
They're kind of like this healthier rawhide thing, and they wrap it with like bacon flavored stuff. Or
I kind of like this company. I do see that over the last 90 days, our earnings estimates going forward to September 2027 are up 7%. There's kind of a big range on that $5 earnings for September 2027. The low's 420, the high is 587. But I would want to know a lot more about the products that they have. But this is a company, and when I say you collect a 3% dividend, I think it was
Almost 3.5.
3.5. This is one, and again, we're talking investing. We're talking about this is a business that you can buy and hold for many years to come. Probably get a nice growth on it, get that nice dividend. I didn't check to see if they increase their dividend on a regular basis, but I believe I did see something like that. But this could be a good investment, but you got to understand. And then also, too, I'd read what the shorts are seeing.
Yeah.
Why do they think this is going to fall? Because that's a pretty big short position on it.
Well, and I was kind of shocked. I mean, they reported earnings here last week, and they had about a 15% jump in the stock price after reporting earnings. And frankly, I'm shocked it wasn't more. I mean, they came out with earnings per share of $2.61. That beat the 90-cent consensus estimate.
What was that earnings again?
261.
Versus 90?
Yeah, versus 90, and more than doubled the highest estimate of $1.20. I mean, this is very interesting that, I mean, they performed that well. They had that big of a short position. I'm almost surprised this thing wasn't up like 50% with that level of a short on it. I mean, I'd have to know more about the quarter because, I mean, that is a massive beat. They give bad guidance going forward because that's huge.
I know. I think a couple months ago we were sitting on more cash than we have since 2008, which we have now done about 3 investments since that time frame. So our cash is lower. I don't know if we would look at something like this or not because we got maybe one more buy left. We were doing the portfolio.
It's a little bit smaller. Market cap's about $1.2 billion.
Ooh, okay, yeah. So,
but I think there's definitely intrigue there.
Well, I mean, we generally buy $30 to $35 million. So we'd still would not be controlling the stock. Could be a little bit hard to get out of. But I just feel good about it. Again, I'd want to learn more about the products. So and again, pet stuff, that's pretty big. So all right, should we go on to
speaking of pets?
Yeah.
Animals.
Yeah, Maple Bear, which has nothing to do with it. And while I'm talking, you're gonna be looking to see if you find anything.
I have it if you want it. So this is according to ChatGPT. The maple part refers to Canada. The founder, Apurva Mehta, is originally from Canada, and the bear part comes from California state flag, which has a bear on it, as Mehta later moved to California.
Okay. I would think with the company name, you want something more related to the product.
Maybe like Instacart.
Yeah, that'd be a great idea. Maple Bear, because it sounds like it's a food or a pet company, or animal company. But anyways, we're going to take a look at it. Their symbol is great. The symbol is CART, C-A-R-T. They're in the internet retail. Float is on the shorts kind of high, 14.3%. Institutional ownership, 86. They got a PE ratio of 22.1 versus 28, so that's positive. Price of sales, 3.2 versus 2.6. Price to book value, 3.1 versus 4.8. And price of cash flow looks okay at 12.2 versus 16.8. Now, for some reason, over the last year, the earnings show that they've declined by 82.7% when the industry was up 48.5%. However, sales for Maple Bear, Instacart, we're going to call it so you know what we're talking about, sales are up 10.2% versus 11.8%. And the 5-year earnings per share growth estimate, 20.5%, while the industry is a negative 2.5%. Unfortunately, no dividend. Don't pay a dividend there. So we do see a balance sheet pretty strong. Current ratio 3.6 versus 1.4. No debt on the balance sheet. That's a big positive. Net profit margin 14.2 versus 9.3. Return on equity 14.6. Free cash flow not that great. $188 million versus $9.2 billion for the industry. So if you got me something good here going forward, this could be a buy, but it's all up to you, Chase.
Yeah, well, current price here again for Maple Bear, and it makes me think of Maple Bar and makes me want a donut. Oh my God, that sounds good. But again, the current price here, $40.19. Their ticker symbol is CART, C-A-R-T. 52-week range here, the low $34.78 and the high $53.50. See the stock, it looks like they went public actually in about 2023, so it hasn't been public very long. But again, kind of languished since it did reach that peak of over $50 a share. Going forward for Instacart, Maple Bear, we go out to December 2026. See estimated earnings per share here of $2.19. Unfortunately, gives us a target sell price of $36.35. I mean, it trades at a valuation of a little bit over 18 times earnings. The growth here is pretty decent. This year, they're looking for earnings growth of 14%. Next year, about 22%. Again, there's a wide variance, though, which is a little bit of a concern.
Yeah, and actually, there's 26 analysts, and talk about a wide variance. The low estimate's 173, the high is 307 to get that 219. So they're kind of all over the board. And is there Maple Bear? Is there only business Instacart? They have anything else?
It looks like it's just Instacart.
Wow.
From what I see.
Yeah.
And the other thing I was going to say about this company that is a little bit concerning is I don't know how wide the moat is on these, right? I know DoorDash now is kind of competing in that space. I think Uber Eats
we
use
used Uber Eats for somebody's birthday this past week, and they were half hour late.
Yeah.
That was Uber Eats,
know.
right?
They were.
Right?
Maybe,
So, yeah.
I mean, but Instacart I don't think does restaurants. I think they just do groceries. But I think the other restaurant players are now getting involved in groceries. I wonder if Maple Bear is going to get involved in restaurants. I don't know.
Interesting story. Thank you, Chase. Thank you for listening to the Smart Investing Show. It is for informational purposes only. It should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great educational information there. Sign up for the newsletter right there at smartinvesting2000.com. Well, thanks for listening. We'll back next week right here on the Smart Investing Show.